for preservation. Oh, sorry. Just to restart, my name is Dan Kolodner because the recording is in progress. I am a partner at Klein Hornig. I'm also on the board of Preservation Massachusetts, and I have been working on historic tax credit deals for about 18 years now. My legal practice is focused on historics and mostly new market tax credits as well, some low-income housing tax credits. Klein Hornig is a tax credit boutique law firm. In other words, we primarily focus on all aspects of tax credits, except for the most part, solar. We don't touch energy tax credits all that much. And the purpose of today's training is to give the basics of the federal historic tax credit. I'll also, throughout the presentation, talk a little bit about the state historic tax credit. To be honest, these sessions on the tax credits, there are 2-day seminars run by Noah Vergratic and iPad and others who will spend 2 days going through this material. So there's a lot to cover, and obviously in an hour you can't get through all of it. But what I'd like to do is go through the basics for about 15 minutes. I'll leave about 10 minutes for questions. If there are things that you'd like to discuss up front, or particular issues you'd like to discuss, feel free to chime in. You cannot throw me off my groove. I give these trainings a lot, and if there are further questions that come up afterwards, my email and my phone number are on this PowerPoint, and you can get the actual PDF of the PowerPoint from Preservation Massachusetts after the fact. You just have to email Joe or contact Erin, and I'm sure they'll be happy to provide it. The reason why I don't give out the PowerPoint directly is that it changes every couple of months, and I just don't want people to have the PowerPoint versus the actual PDF. Just, force the habit, I guess. So I know Joe from Preservation Mass. Mary, could you give me some details about your background? I'm not sure if you can. I see.
Hi, this is Mary Holtor. I'm from Athol. I'm on our downtown Vitality Committee and our Parks and Open Space Committee, and I'm involved with the Historical Commission, and all of that ties together.
Excellent, welcome. And then Springfield Preservation, it looks like. I'm not sure if I can't hear you if you're talking, but that's okay.
Sorry, do you mean the Springfield Preservation Trust?
Excellent, welcome.
I'm Kira. I'm the Advocacy and Community Engagement Coordinator, and glad to be here today.
Nice to have you. And the last one, my screen is counting off. So there's one more person here, but I can't seem to access who it is.
Hi, this is Keith Chenot. I'm the chair of the Fitchburg Historical Commission, and very interested to hear what you have.
Excellent. So I'm going to get going, and if more people join, and if you have questions, like I said, just unmute yourself, and we can, go through this in a way that most benefits the people on the phone. And if you have questions afterwards, my line is always open. I take a lot of questions for Preservation Mass in terms of, they'll ask me if things work or not work. And the legal side of this is mostly related to the credit. So let's talk about what that means. So there are various federal and state incentives that govern a lot of what we do in this country. For changes to the built environment, there's some main ones. There's the Rehabilitation Tax Credit, which is Section 47, the Low-Income Housing Tax Credit, which is Section 42, the New Markets Tax Credit, which is a credit based on the amount of investment, not on the actual changes to the building. There's qualified conservation contributions, which is something I won't be talking about today at all. But that is basically when you make a donation of like a facade or a landscape to a nonprofit and then get a deduction in return. And then there, of course, there's the state tax credits that often go along with the first three. So there is a state historic credit in Massachusetts. There's a state LIHTC credit in Massachusetts. There's not a state new markets credit in Massachusetts. So a lot has been changing in federal historic tax credits over the last few years. There used to be a 10% credit for just old buildings that were not deemed. And then the credit used to be taken over 1 year. Now it's taken over 5. I'll get into that as we go. But effectively, the credit itself has been around for a very long time. It has been around for since 1976. It was redone completely under Reagan's tax reform in '86. And then in the last 10 years or so, there's been a lot of changes and effectively some good, some bad. But at this point, it's pretty stable as an incentive. The state credit as well in Massachusetts is fairly stable. And I think its sunset date is now, I want to say 2027. The Massachusetts state credit has been around for quite some time now. I think it's been through something like, I want to say 40 or 50 rounds. And we'll get into that in just a second. So that's a bit of the history. Let me move slides. Hold on one second. So the federal historic tax credit and the state historic tax credit both have what I call 2 buckets of rules. And when you're trying to access one of these credits, it's important to not just focus on one of the buckets, but also the other. So there's a preservation aspect or a preservation bucket, and then there's a tax aspect, or as I call it, the tax bucket. The preservation aspect is administered by the National Park Service, or NPS, or the SHPO, the State Historic Preservation Office. In Massachusetts, that's the Massachusetts Historic Commission. The tax aspect is, for the federal side, is controlled by the IRS. For the state side, it is controlled mostly by the DOR, the Department of Revenue. I know you guys know this, but a tax credit is different than a deduction. So a tax credit is a dollar for dollar reduction in tax liability. So what we're talking about here is a dollar for dollar reduction in federal tax liability, or a dollar for dollar reduction in state liability. The historic tax credit program is by far the most important in dollar volume federal preservation program. It is literally how we preserve our built environment. And without this program, most of the cities that you like to visit for historic reasons would be very, very different. I've lost count of how many deals I've done in Boston. But if you just go down, most of the drag in the South End, definitely in Charlestown, a huge amount of the North End, and random buildings like Russia Wharf along the Greenway. If you're looking at the Seaport District, all of the Congress Street and Summer Street, that's just Boston. The various downtowns and much of the smaller communities, one way or the other, if there's been a larger historic building redone, it's being redone with historic tax credits for the most part. If you look at, for instance, Lee, it's just an easy one to pull out. They have that main drag in Lee and the main drag in Pittsfield. Almost every building that was redone in Lee used historic credits. All the buildings in Pittsfield along the main drag on North Street have been redone. If you look at Lawrence, Lowell, all of those mill buildings in Lawrence and Lowell were redone using federal and state historic tax credits. So thousands of projects, millions, if not actually not billions of dollars of subsidy. So very important program. But because it has these dual aspects, the National Park Service aspect and the state historic and the IRS aspect, it can be a frustrating program to work with in some ways. And lately it has been a little more frustrating because some of those aspects, especially the NPS and the SHPO aspect, are a little less user-friendly than I would like them to be. So let's talk at first about the National Park Service or the preservation aspects. Because frankly, that's what you'll deal with first, because if you don't have a historic building, you don't get a historic credit, right? So when people come to me and they say, we've got a bunch of stuff in our downtown, but we're not sure if it'll qualify for a subsidy. I usually will say, okay, well, talk to me about the size, talk to me about the use, talk to me about the building, in reverse order. Like, let's talk about the building first. So say you have a federal, say you have a bunch of interesting buildings in your downtown area, or you have an old hospital you're trying to redo, or a mill, okay? There's three parts to getting either a state credit or a federal credit. They sort of mirror each other and they go hand in hand. And then in fact, the SHPO and the National Park Service work together to make sure that these work. There is no longer, like I said, a credit for just an old building that wasn't historic. So you just can't have a building that's old in time and have it work. It actually has to be significant. So how do you determine significance? There's two ways. It can either be listed or be eligible to be listed on the National Register of Historic Places, or it can be in a registered historic district that is certified by the National Park Service as being of historic significance to the historic district. So what does that mean in real life? It means that there's this register of historic buildings that the National Park Service keeps. There is also a state side of this. So you can qualify as a state historic building or certified historic structure, but not a federal. They sometimes disagree. Or you can be in a historic district. And examples of historic districts are the Lowell Mill District, the South End Brownstone District, the district in the Seaport with all the old brick buildings, Channel Center area. A lot of downtowns, the entire Pittsfield Historic District, I believe the historic district, along their downtown. Worcester has a number of historic districts. Boston has a number of historic districts. Or you could create your own district or get something listed on the register. Now, getting something listed on the register is a multi-year process. And in general, your the process that you go through to get something listed, in my opinion, generally needs somebody with a little more knowledge than most of us. There's historic preservation consultants that do this very well. Getting a district listed means that all of the buildings that are slated to be in the district have the right to opt into the district or opt out. It is a complicated process, and a proposed district is actually much tougher to do than a National Register building. So what happens if you don't know? Well, you can go and file a Part 1 with the SHPO, Mass Historic, and the National Park Service. And the Part 1 basically asks someone to come back to you and say, is this building eligible for a credit? What is the evaluation of significance? And then Part 1 is necessary unless it is already listed on the National Register. So if you have a building like the Prudential, which I am sure is on the National Registry at this point, but maybe not. Let's use a different building. Old City Hall in Boston, that is on the National Registry. You don't have to go and file a Part 1. You already know that it will qualify for historic credits if you meet the other tests. But if you're in a district or a proposed National Register building or a proposed district, you have to file a Part 1. And what does a Part 1 look like? It's not as, the form itself is pretty simple. It's on the web, but the data you supply to the Park Service and Massachusetts Historic Commission is quite detailed. It can be a few pages long to hundreds of pages long, depending on the application. And effectively what you're trying to get back is an acknowledgement that this is going to be a certified historic structure. In other words, that the building that we're looking at, not the landscape, it has to be building. The building that we're looking at is such that it meets this standard of being something that is deemed historic. Okay, so that's step 1 of the National Park Service bucket. Step 2 is you've got it back. You're on the National Register. You're in a district. You've got the Part 1 back. You've done your initial filing. You got to tell them what you're going to do. So what the Part 2 is your description of the rehabilitation in detail. This is, again, many pages long. You have a processing fee. It is not as simple as filling out a 1-page form. I tend to recommend historic consultants because they'll do this for you in conjunction with your architect or somebody else. The hard part of this is that you have to know what you want to do to the building before you apply, at least in some form. So if you know you want to use it for residential, you can tell them that. If you know you want to use it for commercial, you can tell them that. There's some mystery that can be in the use, but you have to at least have a basic set of plans and specs. And the Park Service cares and the Mass Historic cares a lot about windows and preserving historic features and things like that. The Part 2 is submitted to the SHPO, namely Mass Historic, and then the SHPO will then forward to the National Park Service. In submitting, you apply at the same time for the state historic tax credits. So in other words, this process on the Part 2 is tied together, the state and the federal. You don't file separate applications, unlike in some states. So what you get when you're finished, you've done the rehab, you've met all the tax rules, you've met all the National Park Service rules, you have rehabilitated the building to the National Park Service Secretary Standards, which is a set of standards that help guide you to maintain the historic status and quality and character of the building. You then have to get a Part 3. And what is that Part 3? That Part 3 is how you certify that the work was done and that it was done to the Secretary Standards. So you apply to the SHPO, the Mass Historic Commission, and then Mass Historic forwards on to the National Park Service. Okay. So that is a very brief synopsis of the National Park Service program. But let's talk a little bit more about it, because the National Park Service and the Massachusetts Historic Commission, it is not as simple as just filing this paperwork. They will want to know in that Part 2 what you're doing with the building. They may have questions. They have the right to put conditions on the Part 2 that you have to follow in your construction to make it work. I tell people that not every deal, just because it's historic, works as a historic project. And that's because the SHPO and the National Park Service do not have to care if the economic use of the building is impacted by the historic features. So the prime example of this that I have is in Worcester, there was an Oddfellows home where there's a massive staircase on the first floor. You go walk into it and it's basically one gigantic, it was like a ballroom staircase, beautiful, gorgeous, right? Absolutely useless. Nobody uses it as a staircase, and impossible to use that as usable space and rentable space. But you have to restore the staircase to make it work for historic purposes. Buildings like that are much more difficult than you think, because you have to preserve that historic feature, which is part and parcel to the building, but it has no economic use. An example of this is old bank buildings with vaults. Sometimes they can ask you to keep the vault, not always. Old abandoned school buildings with a gym, you have to keep the gym. If you want to tear down a portion of the building, that can cause problems. If you want to add an addition to the building, if it's above and you can see it from the street, that won't meet the Secretary Standards. If you want to add a building behind it as an addition, well, maybe that will work, but if it so overwhelms the historic building, like there's a building right now going up in Newton where the front of it is gorgeous, but it's only 2 stories and the back of it's going to be 8 stories or 7 stories, I doubt that will qualify for historic credits, because what you've done as one party is basically change the feature of the area and make it so that this doesn't look like a historic building anymore. So the Secretary Standards are a little complicated. They are focused on preservation, not economics. And just because the incentive is there to help you do these buildings, it does not mean, either from the Mass Historic Commission side or the National Park Service side, that they have to think about that as they're looking at it. Their primary goal is preservation. I will also say that the primary goal isn't necessarily to control your costs. So they will require, for instance, wood windows.
Buses on the streets.
We want to reduce.
Sorry about that. They might require additional build out that you would not necessarily do, like maintaining or restoring wainscoting. They might require that you, in a school building, maintain the hallways as a certain level, maintain the lockers. There are things that you might question that is going to be required, that it will add cost. That's partially why you're going to get a credit. but it is a process. The National Park Service has gotten conservative, especially lately. We have a new reviewer in Massachusetts by the name of Tina Roach for the National Park Service. She's is applying some different standards or more conservative standards than I've seen lately. But you know, I still am doing multiple projects in Mass and other states. It's just that the Park Service cares more about the preservation aspects and the than they do about the economics. My personal view is that's a little short-sighted, because if the buildings don't work from an economic standpoint, they tend to get torn down. And in my career, I've seen a fair number of buildings and inns and old theaters in all sorts of neighborhoods around Massachusetts be eliminated because no one could make the economics work. And sometimes the fault of that laid with the Park Service saying that you couldn't do something. And if you would ask them in a vacuum, they would have probably preserved the building, or they would have probably wanted the building preserved, but they couldn't square the circle between their standards and reality. That's just the program. So when you're looking at it, and when you're looking at using either the state historic credit or the federal credit, or both, or combining this for another purpose, like using it in a affordable housing deal or something else, you really have to start, like I said, about looking at the building and what you're going to do to the building first. Because if you don't want to go through the rest of the analysis with the IRS and structuring and trying to monetize the credits or keep the credits or find a buyer for the credits if it's a state credit, if you don't have a credit, let's start at the very beginning, as Mary Poppins says, a very good place to start. So the start is always the building. Okay, so that's the National Park Service bucket. So what's the IRS bucket and the DOR bucket? Really, it's a tax incentive. So when you think about it, it makes sense that there's a fair number of tax rules associated with these programs. So first of all, it must be a building. So in other words, we have a lot of historic landscapes in Massachusetts. They do not qualify. And a building is defined as a structure or edifice enclosing a space within its walls, and usually covered by a roof. Fenway Park, believe it or not, is a building and got state and federal credits. The building must be depreciable. What does that mean? I mean, that's a big word, right? Depreciable buildings are generally those used for non-residential, i.e. commercial or residential rental purposes. Let me translate that. You can't get state or federal credits on your house. Everybody tries. In some states you can. New York has a program, a few other states have a program, but in Massachusetts, you cannot get state or federal credits on a house you're going to occupy. That is no longer depreciable, right? What it is something, it's not depreciable. It is being used for your own purposes. However, if you rent your house to somebody else and you want to do it, and you own it, but you're using it as a rental, like I have a small condo in the South End from my first place that I lived, God help me, and I could potentially use historic tax credits on that if it wouldn't be too much of a mess, which it would be. So again, that's the first tax rule. So what kind of buildings qualify? Pretty much everything except for personal residence, right? I've done it with industrial buildings. We did a industrial warehouse along the waterfront of Boston, the Canistaro historic building, where they created their own historic district, which was great. And then did an industrial building, came out great. I've done sports facilities and all over the country, tons of theaters, tons of warehouses, a bunch of hotels, random warehouse buildings. I did an aviation center where they used to make B-52s, and then a ton of apartment buildings and office space. It's amazing what you can do with this program, but you can't do your personal residence. You can't get there from here. Okay, so that's the easy part, believe it or not, on the IRS rules. The harder part is you actually have to do a real rehab. You can't just, if you don't get credits, and we'll go into what is a credit and how it's calculated, but you have to have the qualified expenditures that qualify for historic tax credits exceed the adjusted basis in the building within a time frame, either a 24-month time frame or a 60-month time frame. most of the time it's a 24-month time frame. 60-month time frame is for longer projects that require phases, like a large mill building that was going to be done in pieces. And what is the adjusted basis of the building? What does that tax test actually mean? So let me give you a math example. If you have an old building in your downtown that you happen to acquire for $1 million, your acquisition cost is $1 million. You back away land, which is probably, let's say, 100,000 of the actual value. So the actual building is 900,000, the land is 100. Your acquisition basis is 900,000. Sorry, your adjusted basis is 900,000. Your adjusted basis moves over time. It's not a set point. As you do rehab to the building, your adjusted basis goes up. As you depreciate the building, your adjusted basis goes down. But if it's at the point of acquisition, your adjusted basis is just what you acquired it for minus land value. So you have to exceed in cost of what you actually do to the building. For state purposes, it has to exceed 25% of the adjusted basis. And for federal purposes, it has to exceed 100% of the adjusted basis. So the state credit allows for much lighter rehabs, right? So if you acquire it for $1 million and your adjusted basis is 900,000, the state would roughly allow you to spend like 225. The federal says you have to spend at least 900,000, exceed that adjustment basis. For the most part, you tend to way exceed it. These projects tend to be expensive, but if you're doing a light rehab, you have to make sure that you do it. You also have to do it within a time certain. So you can't spread out this rehab over 7 years, doing a unit by unit thing on your building and then still qualify for the historic credit easily. You might be able to justify a 60-month measuring period, but typically it's within a 2-year period. Now, that's not how the credit is calculated. That's just how this test is. So this is the substantial rehab requirement or substantial rehab test. And that is the other thing that you should look at before you start anything. Do you meet the tax tests on the IRS side? So let's say you've got a building. Let's say you have determined that you can do a rehab that will qualify as a substantial rehab. Sorry, as a certified rehab to get your part 2. Let's say that you looked at the tax test and you think you're going to exceed the expenditure number. So everything you spend in that building for this project that is related to construction, that is not personal property, ends up being something called a QRE, a qualified rehabilitation expenditure. And most people just refer to them as QREs, but that is the actual rule. It is the term, and it's in the code, that is related to those development costs on which the state historic tax credit and the federal historic tax credit can be claimed. Now, the definition of QRE is the same for both Massachusetts and federal tax credits. So the next thing on my PowerPoint is lawyer gobbledygook, but let's, just in case you have to look at it later with an accountant, let's look at it. QREs are an amount chargeable to a capital account made in connection with renovation, restoration, or reconstruction of a qualified rehabilitation building, including construction components, except as provided by law. That is a very big way of saying what's on the next slide. And what's on the next slide is, what is a QRE? It's basically your built environment, what you do to it, how you cover it, as long as it's not removable, windows, doors, all HVAC, heating, plumbing fixtures, chimneys, stairs, elevators, sprinkler systems, fire escapes. It also includes, as my son would say, construction period interest and taxes, various fees, architectural fees, engineering fees, construction management fees, a reasonable development fee, which means you get to basically take 10 to 12, maybe 15% of the overall QREs and pay yourself a fee and have that count as a QRE itself. In other words, it allows for a reasonable profit. Okay, what isn't a QRE? It's the land and the interest carry on the land, building acquisition related costs. So if you pay a lawyer to pay for the acquisition, you don't get to count that. Site improvements like landscaping or building up a stone wall or something like that. I did get one site improvement in a prison where they had a prison wall that was actually a room all right around the prison. That counted, but it has to be a building. So a site that doesn't really count as a site improvement. Enlargement. So if you add a floor to your building as a penthouse, which you can do if it's set back from the street and people outside can't see it as much, a setback building, that might work. An enlargement in the basement will potentially count because that floor is already there, but an enlargement above will not. Demolition, not interior demo, but say it's two buildings and one isn't historic and one is, and you have to tear down the non-historic building, that doesn't count. Personal property. So what's personal property? Your stoves, your fridges, your light fixtures that are removable easily, sometimes kitchen cabinets, depending on who you talk to. And then tax exempt use property. It's effectively, if you have a tax exempt taking or using or paying for the credits, you have to be very careful about what they spend on and how they spend it. There's ways around that being an issue, but that's very complicated and requires a little more legal help than I can do in a half an hour. And we'll get into that a little bit as we go. Okay, so this is not something we're going to go into in great detail, but this sample development budget sort of tells you what qualifies and what doesn't. So if you look at the various columns, your first column tells you what is a qualified rehabilitation expenditure. Your second one is what would not, for the most part. And the reason why the development fee in this case is split is that it was a deal that had both both new construction and old and rehab construction. So they backed away some of the development fee relating to the new construction, and then so on and so forth. Okay, so how would you calculate the credit? So the federal credit is a 20% credit on those QREs. So if you have $500,000 of costs that are QREs, and the credit rate is 20%, which it is, taken over, the federal historic credit is now taken over 5 years, 4% a year, but overall 20% of the QREs, you would receive, in this particular example, $100,000 of credit. It is a credit that can be monetized on the federal side. The credits in a federal deal follow baseline profits. So in other words, you can't just sell off the credit. Whoever is in the deal as a partner in the entity that did the work would receive the credits. So investors come in via various structures, but they have to own a piece of the building. And they pay roughly somewhere between 80 and 90 cents per credit, a little less if the deal is super small. A deal with only $500,000 of QREs is probably not financeable with a outside investor. It usually goes to the principals who are actually in the deal, or some local person who wants to take a bit of credit. That's a small amount of credit. Okay. Oh, I have a question. Let's see what it is. If a municipality issues a long-term lease for a building to a private entity, can the developer claim tax credits? Yes. That is more of a 202 question, but it is an excellent example of how a state or a city or a municipality can basically create value by basically entering into a long-term capital lease to a developer. But the devil is in the details. And when I say that, I don't want you to take what I'm saying and go back and say, well, we can do this with no problems. The lease has to be at least a lease that passes the benefits and burdens of ownership. So it has to be a capital lease that effectively is at least, in my view, somewhere north of 60 years. The developer, or the new owner, the ground lessee or the capital lessee needs to actually control the building. So there can't be a sudden take back. And it has to function as if they have transferred it for federal tax purposes. For state purposes, it's a lot easier. If it's only a state historic deal, there's a lot fewer tax rules because the state credit allows nonprofits, not municipal nonprofits, like not your actual city or state, but a friendly, like a developed Springfield, developed Pittsburgh, developed Framingham. If somebody forms an entity 501c3 to support development in that area, they can own the building and get and claim and sell off state historic tax credits. In a federal deal, it's far more complicated. The other thing is that if your plan is to have that municipality long-term lease it, to a private entity and have that private entity lease it right back to that municipality, that is what's called a disqualified lease. And we'll get into that a little bit, but that's a much harder. And I see another question. So is a building listed as a contributing structure within a historic district enough to qualify, or is certification by National Parks an additional step? So if a building is listed as a contributing structure within a historic district, that means that you still have to file a Part 1, but you'll get it automatically. If you're already got a district and you're a contributing structure, you have to jump through the hoop of getting the Part 1, but they'll send it back and say contributing structure in an already district. They check a box. But the only reason why you don't have to file a direct Part 1, whoop, that's my watch. The only reason you don't have to file a Part 1 is if it's already on the National Register. If anyone is interested and has a building, I have many names of historic consultants that are quite good. My apologies if there's ones on the line that I don't know, and you guys are doing this because, on the side. But if it is a complicated listing, I recommend that, unless you feel you have the knowledge already, to employ somebody like them. And I'm happy to give you the names separately if you would like. Okay, I'm going to, I think that answers those questions. I'm sure that I did not answer the, oh, there's one more. What would you consider a minimum investment amount to make HTC work? I get that question every time. And it really depends on who your investor is. So I've seen deals as small as 500,000, where the individuals who take the credit are just the people buying the house, and they're going to use it. There's a guy in Cambridge who buys, and there's a guy actually in Springfield who buys homes, rehabs them, gets a state credit, gets a federal credit, and then rents them out to people. Boom, 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 boom. He's gone through entire neighborhoods, right? Great. Most of the time, though, if you're going out with a long-term, a big investor, a U.S. Bank, a PNC, a Sherwin-Williams, those investors, the direct investors, want deals that are, somewhere between 10 million of QREs and higher. Syndicators might go as low as 5 million of QREs. Individuals, through a broker or somebody else, might go as low as 2 million of QREs. At some point, though, the costs for the accountants, the lawyers, the syndication costs make it very difficult. And I have something on my wall, which you probably can't read. It might be backwards. And it says basically, is the juice worth the squeeze? So I think as you're looking at the building and the size and whether or not it meets the buckets, that's the final question to ask. And I get to that towards the end. So I'm going to keep going so I can cover most of this. And remember, you can always ask me questions later. So how is the credit calculated? Make sure I don't skip anything. Yeah, I did. Okay. So it is, it's actually whatever QREs you generated pursuant to the project, and it can exceed the 24-month or 60-month period that we talked about before. Sometimes, people will redo the roof 5 years earlier and then have to wait to raise money. Keep your records. Believe it or not, in a lot of cases, you can count those costs. At some point, it gets too attenuated, right? The building work you did in 1995 doesn't count for a 2023 credit. But you can talk to an accountant. You can keep the records. You never know. So when is the credit taken in, and when does all this happen? So the credit flows from the federal side upon placement and service of the building. What does that mean? It usually means a C of O. If you plan on monetizing a federal credit, you have to have your investors in the deal owning whatever they're going to own or being a part of the master tenant structure prior to that placement and service. Every year, somebody calls me, all happy they finished their building, and tells me they want to monetize the credit. I've had more than one person in tears on my phone because they thought they were doing everything right. They filed their Part 1 and Part 2 and didn't bring in their investor. And they are the proud owner of a lot of federal historic tax credits. Now, maybe that's what they wanted, but more often than not, they wanted to bring in somebody else to pay off their debt, and now they can't. And I'm not talking, this process takes months to bring in somebody. So it's not something that Generally, it's best to start either before construction starts or well in advance of construction completion. Now, you have to start the National Park Service process before you start anything, because if you start construction and it turns out you did something wrong that they don't agree with, it may be too late to fix and you've blown your credits. One other thing I'll note is that you have to watch out for occupied or something called rolling rehabs. So just note that if you have a building that you're rehabbing with tenants in place, you effectively place a building in service the moment you exceed that adjusted basis that we talked about a few slides ago. So on a rolling rehab like affordable housing or a residential building where you're spending millions, but it's unit by unit and you're moving people in as soon as you're done with that unit, you need to have your investor in as early as possible if they're going to take the credit and it's not going to be the current owners. So the credits belong to the taxpayer that owns title to the property when the QRAs are placed in service. You are allowed to pass through those credits to a long-term lessee. That's the master lease pass-through structure, or you know, people talk about master leases in these deals. When the property owner is a pass-through entity, the credits are allocated in accordance with operating profits, baseline profits. So in other words, if you have an entity that is two or more members, the members get the credits in accordance to how they split the profits in the deal. And just very quickly, it's claimed on IRS Form 3468. I will note that I'm going to go back a little bit. The state credit is done differently. So on the federal credit, you get the credit as of right. I'm just going to pause here and talk about the state credit. The state credit is not as of right. In other words, if you file the Part 1 and Part 2 and Part 3 for the federal and meet the tax rules, you get to claim it on Form 3468. Not the same way for state. For the state credit, you have to apply through 3 different rounds throughout the year, and it's part and parcel of the Park Service process and the Part 2 process, but you apply and you can apply for as many rounds as you want up until placement in service. You have to have some dominion and control over the property, either a P&S or an ownership, and you apply to MHC, the Mass Historic Commission. MHC usually turns people down the first time. They deny that, but they do. And it can take years to get your full allotment of credit. So the federal credit is 20% of your QREs. The state credit can be up to 20% of your QREs, but because they parcel out in dribs and drabs, it can take years and you don't usually get that high. Now, if I was running the program, I would pick fewer projects and fund them fully and really supercharge development in the state of Massachusetts, the Commonwealth. That's not how MHC has chosen to do it. It's been that way since the beginning of the program. I find it very frustrating, but unfortunately, I don't make the rules. So it can take years to get a full allotment. One thing a state nonprofit can do in your local jurisdiction, a number of you seem to be involved in city government, is you can prime projects by applying for them and starting the process. So there are some theaters and some nonprofits that have been applying for 3 or 4 years and have built up 20%. And now it's a far more likely project to happen because they've reached close to their goal. And there are some projects that apply, start construction and get 3 rounds and basically qualify for 5, 6, 7, 8, 10% of what they could have qualified for instead of the 20%. On the state credit, you get a certificate back from the state when you file the Part 3. You cannot get the state credit until you file the Part 3. The state credit is freely monetizable. It can be allocated to partners or certificated, and that certificate can be sold like negotiable paper. So in other words, you have brokers that will reach out to you once you get a state credit and say, if you're going to certificate, think of me. I have a buyer, Apple, Macy's, John Hancock, whoever it might be. Nobody works directly through those buyers. The vast majority of the time they use a broker. State tax credits right now in Massachusetts are selling in a certificated manner for 92 cents, 91 cents, which includes the broker fee. So probably 94 cents to the buyer. The buyers of state credits have no recapture risk. The recapture risk stays with the sponsor or the seller. And it's a really great program from a sale perspective and a really not efficient program from a allocation perspective and how it gets to the projects. You know, if somebody knows someone at MHC, you know, I mean, we've all had that discussion with MHC. It's not going to change, but it really hurts the projects and hurts development in Massachusetts for historics to have such a great subsidy in some ways and have it slow down projects tremendously. So I want to keep going. I do want to make sure I leave you with a few things that are important and things for you to think about. One is that there are issues with tax exempts and historic tax credits on the federal side. On the state side, all of these issues do not exist. On the federal side, though, there are issues with something called tax exempt ownership and tax exempt use. So for tax exempt ownership, a nonprofit that owns a building cannot claim federal historic tax credits and cannot own directly a federal historic tax credit building and still get tax credits, even if it's going to an investor. So what happens instead is that a blocker is used, a blocker entity, a for-profit sub, that for the 5 years steps in between the nonprofit and the deal, and that's how we fix that issue. For the most part, there's other fixes, but that's the main fix. For tax exempt use, there is a 50% safe harbor for tax exempt use. So if a building is being leased to a nonprofit or a foreign entity or somebody like that, you're allowed to not worry about that type of leasing if it's under 50% of the net rentable square footage. So if in a 3-story building, if the first story is commercial, the second story is rented to U-Haul, and the third story is rented to the American Cancer Society, you are fine. You don't have a tax exempt use problem. If floors 2 and 3 are, you have a tax exempt use problem. Is that death? No. You do have to worry about it though, and there's ways to structure around it. For the most part, sometimes not. And I'll get into that in a second. So what is a tax exempt? Just remember that it's all government entities, state entities, exemption entities like a 501c3, a foreign person or entity. Occasionally, I have a couple of investors from Israel and from Canada, damn Canadians, Mexico, Japan. And if they don't pay US tax, they're a foreign entity and they qualify as a tax exempt. They don't pay tax. An Indian tribal government that doesn't really affect us that much in Massachusetts, unlike some of the states in the Southwest, but it occasionally comes up here. The entity that makes the sub entity for tax exempt ownership, you have to make sure that they can make that election to do so. So some governmental state agencies cannot. So what in those cases, it tends to transfer to another nonprofit, like a community development entity in its local area, and then that entity makes the election. And then the reason why there's an issue with the tax exempt is the end user of the building is that that impacts tax exempt use. And then because there are certain users of the building that through a disqualified lease, that if they extend more than 50%, there is no fix. So you're going to lease the entire building to the American Heart Association, and they didn't own the building to begin with. In all likelihood, that's fine. You just have to structure it the right way. If you're going to lease the entire thing if the Museum of Arts is going to rehab its own building and lease it back to itself, it is a disqualified lease. They can lease back 50% of it to itself and it's fine. The moment they go to 51% or 50.1%, they have blown disqualified lease and they lose 50% of the credit. So if they lease 80% back to themselves, if they owned it before, then they lose 80. What I want to leave you with for tax exempt ownership and use is that these are some of the hardest topics in my field. And there's absolutely no way in a 1-hour presentation I can give you the full nuance, but I can make you issue spot. I mean, we tell this to young lawyers, you know, it's not your job to solve, but you need to be able to recognize. So recognize that if you have tax exempts in your structure, it's complicated. Recognize that these rules have to be, both the Park Service rules and the IRS rules have to be followed. Tax exempt rules are all IRS rules. And while we can be creative, sometimes the deals just don't work. Again, like the National Park Service isn't responsible for your economic use of your building, the IRS isn't responsible for making sure that your structure fits their parameters. You have to adapt to them. Okay, moving on. I'm not going to talk much about recapture except to say that it exists. You can lose the credits if you don't do certain things. And you know, it's part and parcel of why hiring like accountants and lawyers and folks like us works. I've listed out some of the recapture risks here. I'm not going to go through the detail because I also include a lovely mitigation strategy slide, which you can go through on your own. I'm going to very briefly touch on the various structures. So remember, for the state historic tax credit, you get the credit, you get a certificate, you sell the certificate. There are structures using donations, and when you sell the certificate, the sale of the certificate is actually income to the project. So if your owner is a tax exempt and you're not going to get federal credits, it's not usually a big deal. If it's not, it is a big deal and you have to worry about it, but I'm not going to talk about how to deal with it because again, we have only 10-15 minutes left and it's complicated. But I will talk about the single entity structure and the master lease structure. So on the federal side, remember the tax credit investor has to be the 99% owner of the project to get 99% of the historic tax credit. So they can come in directly to the fee owner, like here, where they own 99% of the credits, profits, and losses and cash flow. They are actually getting a very limited stream of cash, believe it or not, and the credits in reality. The managing member owns 1%. And then at the end of the 5-year historic compliance period, and I should have mentioned that, historic tax credits on both state and federal level have a 5-year compliance period with a burn off for the federal side of 20% every year and a burn off for recapture purposes on the state side of 1/60th every month. So state credits on a monthly basis, federal credits on an annual basis. So at the end of the 5 years, the investor usually gets out via a put. The interests in the entity also can flip. So the managing member becomes the 5% owner, the tax credit investor the managing member becomes the 95% owner, the tax credit investor in the slide becomes the 5% owner, so on and so forth. Okay. There is a more complicated structure that is used on larger deals called the master lease pass-through structure. That's where the tax credits are passed through via a pass-through election that's filed with a return to a new entity called the master tenant. The master tenant is owned by the tax credit investor 99%, and all those credits flow out to them. So the credits flow from the landlord, they elect to pass through. The master tenant is a master tenant in a long-term lease, pursuant to that rule that we talked about earlier, that said that they could claim the credits in long-term lessees. And again, this works well and allows you to get financing that's a little separate, which is good. What I'll say though, is that smaller deals tend not to use this as much, and some investors won't do it, like Berkshire Bank or Twain. They tend to not like the lease pass-through structure for some of the tax implications of that structure. So as you're going through your process, do I have a building? Do I meet the test? Is my rehab going to work? Do I meet the IRS tests? And you start to think about which investor, if you can qualify for investor, or if your individual real estate developer can keep the credits, how do they want to do it? That's usually when this structure comes about. I will tell you that local real estate lawyers and accountants usually can't handle this as much as they can do a real estate closing or bank closing. It's hard for them to do the actual more complicated structures that involve these credits. On some of the smaller deals they do, of course, and it's just simple filing. On the larger deals, it tends to involve a lot of people. So we're going to quickly move past the lease pass-through structure because we're running out of time. We've talked about how the credit is previously. I talked a little bit about the revenue procedure earlier, and effectively what the revenue procedure is that the IRS put out in 2014 a safe harbor for audit, and because there was a bunch of cases over the years before that, including something called the historic boardwalk hall case, that effectively said that, hey, some of these people coming into these deals are not really partners and shouldn't be able to claim the credit. So the IRS, at the request of the historic coalition, of which there's a lot of people in, set out a safe harbor that said, look, we're not trying to kill your program, but if you do these various things, all of the investors will be respected as partners. So most of the deals, 99.99% of the deals are structured this way now. There's guidance as to what you have to do. Most of the things I've talked about so far have met all the things I've talked about so far. I've met the guidance, your investors and your individuals should all endeavor to meet it. It's worth it. I'm going to quickly scroll through and talk about some special concerns for those new to HTC, and then I'll answer questions. So there have been some price reductions in the credit over the last few years because in tax reform in 2017, they didn't eliminate the credit, but they moved it to a 5-year credit. So it used to be that the federal credit was quite lucrative, but because of 50D reform and master lease, which I won't get into, but it caused some pricing adjusters. So you have to be realistic about what you're going to get. And I also tell people to make sure they understand what the net is, because the tax credit investor oftentimes will pay somewhere in the 80s for credit, and then they'll want a preferred return of 1 or 2% of what they paid in each year, and then they might want a 5% exit. So your net becomes far less. But if you combined it with your state credit, if you get a state credit, you know, the various costs to do this end up making it worth it on projects of a certain size and higher. So size does matter. Some projects are just too small. Now, when I say that, I've seen projects super teeny when someone is taking the credit themselves. But if you're going to try and monetize it and make it a project that brings in outside capital, you either have to find a very friendly buyer, like a local bank who's willing to do it. You know, there's been a couple of those over the years, or a rich individual who can take it and meets the rules for taking it. The tax rules for individuals taking the credit are different than widely held fees. Anyone who wants to take the credit needs to vet it and make sure they can actually use the credit. If you're bringing that person to the table, you have to help them make sure that it works. So I usually tell my clients, is it worth it to monetize the credits? Do you want to partner? Some people are very unhappy having a tax credit investor tell them anything. You know, I've been working on this project for 10 years. How dare you tell me that I need to cash flow in this way? Well, they're putting in millions of dollars potentially into that building, and you signed a partnership agreement that says they have that power. It matters. Can you take the tax credits yourself? There are three things: passive loss rules, at-risk rules, and whether or not you file as a real estate professional. Those 3 topics can take an hour to discuss, so I'm not going to get into them here. But suffice it to say that rich individuals who do real estate oftentimes can qualify and take the tax credits. Whether or not they want to is a different question. Whether or not their accountant on the individual side wants to mess with it is a separate question. So time matters. Some projects are too far along or not far along enough. In other words, if you're going to do this, you have to figure out what your rehab is. You have to figure out what it will cost you to do that rehab in a historic fashion. You have to figure out transaction costs. As much as I'm a lovely guy, I'm not free. And other people, if you don't want to use me, aren't free. And the accountants aren't free. And the historic consultants aren't free. So at some point, unless you're willing to put in a fair amount of sweat equity, which can help with some of that, but not all, and unless you have specialized knowledge already, it can be very expensive to do a small project. The amount of work that goes into a small project is not all that different from a large project. Now, you can combine buildings to make your project bigger. You can work with a knowledgeable party who can bring knowledge and already, existing infrastructure to the deal. But it is something to consider. If the rehab has already started, does that kill a historic rehab? No, but it's much harder. You've already gone down the road without the Park Service approval. That you didn't fill up the first bucket. That's a problem. And then I'm going to be a little selfish here. Team matters. If you are working with people, either contractors or architects or lawyers or accountants or historic preservationists, I don't know how they would say this, but and they've never done a historic deal before, my advice, unless you're willing to educate, is to walk away. These are specialized projects, and you kind of need someone who knows what they're doing, especially the architects and contractors. There's lots of real estate lawyers who will go and pull the Section 47 down from the shelf and try to understand it. A lot of times they hire people like me to be special tax counsel. On the accounting side, if you have a deal of size, you need someone who knows what they're doing on accounting. It cannot be the family accountant. They just will blow it. they'll screw up the tests, they'll screw up the numbers, and then you'll lose the credit. Okay, so that's it. My phone number is included. That is my office line. Leave a message. I never pick it up because I usually give out my cell. And you can always send me emails. There was another question. Oh, very informative. Thank you. So what I would say is we're done with our hour. I'm more than happy to answer questions. Preservation Mass, I would encourage you to go first to Preservation Mass. Hey, Joe, I'll send you a PDF of it. I would prefer not to send that PowerPoint out to people if that's okay.
Perfect.
So if you have questions, what I would suggest first is, and I should have mentioned this, Preservation Mass has a circuit rider program where they will provide you with help on almost any project, where they'll give you most of this knowledge from a non-lawyer perspective, and they will bring me in if needed. And that doesn't mean I would represent you, but I can come in and answer questions. I'm happy to do so. I'm a preservationist at heart. I would not be part of this if I wasn't. I mean, I'm obviously not going to do all the legal work without, you know, an engagement letter and stuff like that, but I can at least guide you the right way. If there are projects that are 10 years, 5 years, 6 years, 3 years down the road, and if you're a governmental participant trying to plan for it, give me a call. When I have a slow morning, I'm happy to come in and talk to other people in your government and try and lead you through it. You can also email me specific questions, emails and calls. I'm busy, so it might take me a few days to get back to you. I do recommend that you call and involve Preservation Massachusetts. We are blessed in Massachusetts to have a strong statewide org with good contacts in the government, both federal and state. Not every state has that, and frankly, they can provide knowledge about stuff that even I haven't seen, and they see all the deals for when they have to apply for the state tax credit. So don't forget you have a friend in Preservation Mass. Happy to answer questions later. Thank you for being in this training. Happy to do it. And Joe, I think that's it.
All right. Thank you so much, Dan. That was a very interesting and informative program on the state and federal historic tax programs. As Dan said, Preservation Massachusetts is always willing to help with your preservation projects or questions that you might have, whether it's about the tax credit programs or any other preservation issue. So feel free to reach out through us. This conversation, as with the rest of our preservation conversations, will be available on our website at preservationmass.org, as well as our YouTube channel. So stay posted or stay tuned in the next couple of days, and this conversation will be uploaded. So without further ado, thank you again to Dan Kolodner, our wonderful speaker today. And thank you everyone for tuning in. Have a nice afternoon.
Bye, everybody.
Bye-bye.